Hello all, today we're going to be talking about the double entry system of accounting and how you can use it to record journal entries. What exactly is the double entry system of accounting? Well, this double entry system of accounting is a system where every business transaction affects a minimum of at least two accounts. An account is a detailed record of all increases and decreases that have occurred in an individual asset, liability, or equity during a specific period. Pretty much everything that a company owns or everything that a company does is going to fall into these three categories, but equity has three subcomponents, and they are revenues, expenses, and withdrawals. Before you start recording a journal entry, you're going to want to have a chart of accounts ready. A chart of accounts is a list of all the accounts that a company uses to record its books, and they're separated into these six classes. The first is assets, things that a company is going to use to make a profit in the future. It takes money to make money, so cash will be an asset. Companies are going to have supplies on hand in order to do their normal functions, so supplies are an asset. If you are a manufacturing company, you're going to need equipment to make things, so equipment would also be an asset. Liabilities are things that your company owes to another company. If it's through the course of normal business, it's going to go into accounts payable. If it's salaries, specifically, that you owe your employees, it's going to go under salaries payable. And if it's to a bank or borrowing long term, it's going to be recorded under notes payable. Equity accounts track an owner's stake in the business. It is essentially how much the owner would get if the owner sold all the company's assets to pay off all the company's liabilities and took what was left over. In this course, we're only going to have one equity account, and it's going to be owner's capital. Revenue accounts track the amount of work that a company has done during the period, and it depends on what type of company it is. If you're a service business, you're going to record it under service revenue. If you are a sales business, you're going to record it under sales revenue. Expenses are the costs that a company pays during its everyday operations. Well, companies need a building to operate out of, so if they pay rent, rent will be recorded under rent expense. They need to pay their employees, so salaries will be recorded under salaries expense. They need to have power and heat, so utilities will be recorded under utilities expense. These are all things that a business must have in order to still be productive. The last type of account we have is withdrawals. They are funds that an owner takes out of a business for his or her own personal use. Whenever a transaction happens, we're going to record it under a journal entry using this journal entry template. On the left side in the box, you're going to record the date that the transaction happened. On the top line, which is called the debit line, you record one of the accounts being affected and the amount. And on the second line down, which is the credit line, you're going to record the second account being affected and the amount. The debit line's amount goes into the left column, and the credit line's account goes into the right column. Lastly, at the bottom, you're going to put a brief description of what happened during the transaction. How do you know what to debit and what to credit? Well, you're going to use the 5 steps to recording a journal entry. The first step is to analyze the transaction and determine what 2 or more accounts are being affected during the transaction. The second step is to determine what type of accounts those accounts are. The third step is to figure out whether the overall value of each account is going to increase or decrease after the transaction. And the fourth step is to determine what side, and by that I mean debit or credit, of a T account these accounts increase or decrease on. And lastly, in step 5, we're going to put it all together and we're going to record the entry. Some questions you want to ask yourself when you're trying to figure out what accounts are being affected are these. What did we pay for and how are we paying for it? Or what did we do to earn revenue and how are we paid? So let's start with step 1. We're going to analyze the transaction and determine what accounts are being affected. Let's take this transaction. On January 1st, 2019, Peters Painters purchased $1,000 worth of painting supplies in cash. What 2 accounts are being affected? Well, we'll ask ourselves the question, what are we paying for and how are we paying for it? What we're paying for is supplies, and how Peters Painters is paying for those supplies is in cash. So the 2 accounts being affected in this transaction are supplies and cash. In step 2, we need to determine what type of accounts those accounts are. So we'll go to our chart of accounts. The first account being affected for supplies, we look around, we find it, and we see that it is in the assets column. So supplies is an asset. The other account being affected is cash. We look around our chart and find it, and we see that cash is also an asset. So in this example, both accounts being affected are assets. In step 3, we need to figure out whether the overall value of these accounts is increasing or decreasing. Well, if Peters Painters is buying supplies, the total amount of supplies that the company has is going to go up, therefore the overall value of the account is increasing. They're paying for these supplies in cash, presumably out of their bank account, So after these supplies are purchased, the value of that bank account is going to decrease and the overall value of their cash account is decreasing. In step 4, we need to determine what side, debit or credit, of a T account these accounts increase or decrease on. And I've given you guys this handy dandy little reference guide. In our transaction, supplies and cash are being affected, and they are both assets. So we see that assets are going to increase with a debit and decrease with a credit. And lastly, in step 5, we put it all together and record the entry. So our transaction, once again, is that on January 1st, 2019, Peters Painters purchased $1,000 worth of painting supplies in cash. In step 1, we analyze the transaction and we determine what accounts are being affected. The two accounts being affected were supplies and cash. In step 2, we determined what type of accounts those accounts are, and we went to our chart of accounts and we determined that both of these accounts are assets. In step 3, we need to figure out whether these accounts are increasing or decreasing. We're buying supplies, so the value of our supplies account is increasing, and we're paying in cash, so the value of our cash account is decreasing. In step 4, we need to determine what side those accounts increase on. They are both assets, and assets are going to increase with a debit and decrease with a credit. So let's put it all together. First things first, supplies, which is one of our asset accounts, is increasing, and because it's an asset, it is going to increase with a debit. Cash, which is also an asset account, is decreasing, and because it is an asset, it is going to decrease with a credit. So now we can record the journal entry for this transaction. We went through, and in step 5 we determined these two things: that supplies, an asset, is increasing with a debit; cash, an asset, is decreasing with a credit. I remind you that the top line in the journal entry is always the debit line, and the second line down is always the credit line. We're going to start with the box on the left hand side by putting in the date that the transaction happened on. This transaction is happening on January 1st. On the top line, the debit line, we're going to list the account name which is being debited. In this example, the account that is being debited is supplies, so we put supplies on the debit line. In the columns on the side, we're going to put the amount of supplies that Peters Painters is purchasing. They are purchasing $1,000 worth of supplies. On the second line down, the credit line, we're going to put the account which is being credited. In this case, the account that's being credited is cash. And you'll notice it's proper form to indent your credits from your debits. We're going to record how much cash Peters Painters is paying for these supplies. Always going to be $1,000. And a brief description. What happened in this transaction? Well, Peters Painters purchased supplies. Let's take another example. That on January 2nd, 2019, Peters Painters purchased $5,000 worth of painting equipment on account. What's happening in this transaction? Well, let's take step 1. We're going to analyze the transaction and determine what accounts are being affected. We're going to ask ourselves, what are we buying and how are we paying for it? What is Peters Painters buying? Peters Painters is buying equipment. And how is Peters Painters paying for this equipment? They're paying for it on account. That is fancy accounting lingo to say that they're getting the asset, the equipment, now, and they're going to pay for it later. And when things are paid for on account, they're recorded under the account accounts payable. So in this example, the two accounts being affected are equipment and accounts payable. In step 2, we need to determine what type of accounts these accounts are. So we're going to go to our chart of accounts. We look around and we find equipment, and we see that it is in the asset column, so equipment is an asset. We look around, we find accounts payable, and we see it is in the liabilities column, so accounts payable is a liability account. In step 3, we figure out whether these accounts are increasing or decreasing. Our equipment account is going to increase because after Peters Painters makes this transaction, the company is going to have more equipment. However, the company is also going to owe more money. So our equipment account is increasing and our accounts payable account is also increasing. In step 4, we need to determine what side these accounts increase or decrease on. Well, we go to our reference guide that I've given you, and we know that assets increase with a debit and decrease with a credit. Accounts payable is a liability account. We go to the chart and we see that liabilities decrease with a debit and increase with a credit. And now that we know that, we can move on to step 5. And step 5 is to put it all together and record the entry. So first things first, equipment, our asset account, is going to increase, and because it is an asset account, it is going to increase with a debit. Accounts payable, which is a liability, is going to increase, and like all liabilities, it's going to increase with a credit. So now it's time to record the journal entry for this transaction. We've already determined in step 5 what accounts are going to be affected and which ones are going to be debited and credited. So let's fill in the journal entry. First things first, let's put the date in the box. It is January 2nd. On the top line, the debit line, we're going to record the account which is being debited. In this case, equipment is being debited, and we're going to debit it for the amount of equipment that we're purchasing, which is $5,000. Second line down is going to be our credit line. The account being credited is accounts payable, and we're going to enter that in the right column for the amount that we are going to owe for this equipment, which is $5,000. And at the bottom, we're going to put a brief description of what is happening in this transaction. We purchased equipment on account. Let's take another example. That on January 3rd, 2019, Peters Painters performed $1,500 worth of painting services for Adorable Apartments, which is another company, and Adorable Apartments is going to pay Peters Painters in cash. Let's analyze the transaction and determine what accounts are being affected. We're going to ask ourselves the question, what are we doing to earn revenue and how are we being paid? What are Peters Painters doing to earn revenue? They are providing services. And how is Adorable Apartments paying Peters Painters for these services? They are paying them in cash. So the two accounts being affected are cash and service revenue. In step 2, we're going to determine what type of accounts those accounts are. We go to our chart of accounts, we find cash, and we see that cash is in the asset column, so cash is an asset. And we find service revenue, which is in the revenues column, so service revenue is a revenue account. We have one asset and one revenue being affected. In step 3, we need to figure out whether these accounts are increasing or decreasing. Well, our cash account tracks how much money we have in the bank. After Adorable Apartments pays us, Peters Painters is going to have more cash, so the cash account is increasing. Service revenue tracks the total amount of services that we've done during the period, regardless of how we got paid. After we perform these services for Adorable Apartments, the service revenue account is going to increase. So in step 4, we need to determine what side these accounts increase or decrease on. Cash is an asset, increases with a debit, and decreases with a credit. Our other account is a revenue account, and revenues always decrease with a debit and increase with a credit. Now we can move on to step 5. We're going to put it all together and we're going to record the entry. What is happening here? Well, firstly, cash, which is an asset, is increasing, and because it's an asset, it is going to increase with a debit. Service revenue, our revenue account, is also increasing, and as the guide has told us, revenue accounts increase with a credit. Now we're prepared to record the journal entry for the January 3rd transaction. We're going to start by entering the date. The transaction is taking place on January 3rd. We determine in step 5 that the account that is going to increase with the debit is cash, so we're going to record cash on the debit line for the amount of cash we're receiving for providing these services, $1,500. On the credit line, we're going to record the account being credited, which is service revenue, for the amount of work that we did, which was $1,500 worth. Debits always equal credits. On the bottom, we're going to record a brief description of our transaction. What happened here? We performed cash services. Let's take another example. That on January 7th, 2019, Peters Painters paid weekly employee salaries of $1,400 in cash. Let's start with step 1. We're going to analyze the transaction and determine what accounts are being affected. In this case, what are we paying for and how are we paying? Well, what are we paying for? We're paying our employees their salaries. And how are we paying our employees? We're paying them in cash. So the two accounts that are being affected are salaries expense and cash. In step 2, we need to determine what type of accounts these accounts are. We're going to go back to our chart of accounts and we're going to see that salaries expense is in the expense column. Therefore, salaries expense is an expense account. Makes sense. And we've already determined several times that cash is an asset. So the two accounts are one expense and one asset. In step 3, we need to figure out whether these accounts are increasing or decreasing. Salaries expense tracks how much salary we've paid our employees over a period of time, in this case January. After we pay our employees their paycheck, the total amount of salaries we paid is going to increase and our cash is going to decrease. In step 4, we need to determine what side of these accounts increase or decrease on. Expenses are going to increase with a debit and decrease with a credit. Assets increase with a debit and decrease with a credit. Now we're prepared for step 5. We're going to put it all together so we can record the entry. First things first, salaries expense. Our expense account is increasing, and like all expense accounts, it's going to increase with a debit. cash, our asset account, is decreasing, and because it's an asset account, it decreases with a credit. So we're ready to record this transaction. Start with the date again. It is January 7th. The account that is being debited is salaries expense. We already determined this in step 5. And we're going to debit it for the amount of cash that we are paying our employees, which is $1,400. The account to be credited is cash, our asset account, which is decreasing with a credit. So we're going to credit cash, and we're going to credit for the same $1,400. A brief description of the transaction says that we paid employee salaries. One more example. On January 10th, 2019, Peter's Painters owner, who I presume is named Peter, is going to withdraw $600 in cash from the business. This is a little different, but we are going to analyze the transaction and determine what accounts are being affected. In this case, what is happening? The owner, Peter, is withdrawing money, and if he's withdrawing money from the business's cash account is going to decrease. So the two accounts being affected are owner's withdrawals and cash. In step 2, we need to determine what type of accounts these are. Back to our chart of accounts. Owner's withdrawals is the only account under our withdrawal account, so it's a withdrawal account, and cash, once again, is an asset. We have one withdrawal account and one asset account being affected in this transaction. We need to figure out whether these accounts are increasing or decreasing. Owner's withdrawals tracks how much money an owner took out of the business over a period of time. In this case, after Peter withdraws this $600, the total amount of withdrawals he's taken is going to increase, and because he's taking it out of the business, the company's cash account is going to decrease. So owner's withdrawals going up, cash going down. In step 4, we need to determine what side these accounts increase or decrease on. One last time, let's go to our reference guide. We'll find that withdrawals increase with a debit and decrease with a credit, and that assets increase with a debit and decrease with a credit. And now we're prepared for step 5 to put it all together and record the entry. We've determined that owner's withdrawals, which is a withdrawal account, is going to increase, and like all withdrawal accounts, it's going to increase with a debit. And that cash, our asset, is going to decrease, and because it's an asset, it will decrease with a credit. We're ready to record the January 10th journal entry for this transaction. We're going to start by recording the date. It is January 10th. And in the debit line, we're going to record the account to be debited, which we've determined is owner's withdrawals. We're going to debit it for the amount of money that Peter is taking out of the business, which is $600. Goes in the left-hand column because debit means left. The account being credited in this transaction is cash, and we're going to credit it for that same $600. And lastly, we're going to have a brief description of what happened in the transaction. Our owner withdrew funds for personal use. I hope you all enjoyed this. Have a good day.